Equity markets have continued to make progress during April, despite disappointing economic news flow and some poor corporate profits. Now, global debt continues to increase, and austerity programs seem to be making little impact on government finances. Corporates are buying back their own shares rather than investing for growth. Now, I'm here with Mark Burgess to go through Columbia Threadneedle Investments themes and outlook. Hi, Mark.
Hi, Debs.
Now, let's start with the rotation situation. What sectors are under pressure and what are doing well?
We saw last year pretty much anything that was exposed to a China slowdown, particularly energy and commodity companies, really fall very sharply and significantly underperform the broader markets, whether you were in UK equities or European equities or US equities. Globally, those sectors did very badly. This year, we've seen those sectors bounce back quite strongly. I think it's a function of both valuations getting really quite stretched, so good growth stocks became quite expensive versus the bad value stocks, if you like. Yeah. And secondly, we saw some stimulus out of China at the beginning of the year to really try and reboot their economy, and the energy and commodity companies in particular responded pretty favourably to that. So far this year, those sectors have done very well, but we have to remember they've come off quite a low base.
Now, in terms of the growth outlook, do you think we are seeing a slowdown?
We are seeing a slowdown. I think if one looks at leading indicators across the globe, they're all showing some softness for GDP growth. And there are different reasons for that depending on where you are. Clearly in the UK we've got Brexit fears. In Europe, the migration crisis and the lack of political union we've got around that. In the US, we've got the US election, and we've also got softness coming out of the energy sector. So different reasons for that globally. And again, in Japan, also, the lack of response to the Abenomics program. I guess the one ray of light, and I use that term carefully, is that, as I say, China did stimulate its economy. So the Chinese data has got a bit better, but we think that's going to be relatively short-lived.
Okay, then moving on from China to the States, are we still bullish on the dollar?
I think the US is still going to have the strongest relative economy versus the rest of the developed world, and that will naturally put upward pressure on the dollar as the US interest rate cycle will tighten earlier than the rest of the world. Saying that, we think that tightening cycle is going to be very modest, and whereas one might have expected the dollar to be stronger at this point in the cycle a couple of months ago, we now think the rise will be relatively modest.
What do you think will be the impact for China and the other emerging markets?
Well, a strong dollar last year was one of the reasons why emerging markets did so badly. Lots of other reasons as well. The commodity price collapse that we've discussed was one of those reasons. But certainly a strong dollar has historically been pretty negative for the emerging markets. So if the dollar isn't going to be very strong, then that will certainly help the emerging markets' performance out.
Okay. So, Mark, do you think there's another US rate rise due anytime soon?
The market thinks 50-50 this year, and if I, as a betting man, I'd say we probably won't see another one. I think the Fed is mindful of the impacts that a stronger dollar will have on the global economy, as we've just discussed. And also the statistics are showing that the economy is slightly rolling over. We're seeing a bit of inflationary pressure come through, and that's a new thing. So that may well tip them to tighten again this year. But I think there are lots of reasons why they won't. So on balance, I don't think they will. If they do tighten again, it will be just once. There won't be another 2 or 3 behind it.
Okay. Now, finally, bond markets. Are we back to business as usual?
Well, in the equity market sell-off that we saw in February, bond markets performed very well as a massive risk-off kind of environment took hold, and there was a flight to safety by investors, and they bought government bonds very heavily. We've seen them step away from that. So as equity markets have recovered their poise, we've seen bond markets sell off a bit and yields back up. We've also seen credit perform very well as the ECB stepped in and broadened its quantitative easing program. So all of that's made the bond market look more interesting and more normal. And for choice, we think bond yields, certainly from government bonds, will continue to rise from these historically very low levels.
Okay. Well, thank you very much for your time, Mark. And thank you for watching. We'll be back again soon.